All right, so we're still working on problem 13.8a, an example of how to prepare the cash flow statement. We've gone through the operating activities section under the direct and the indirect method and came up with the same amount of cash provided by operating activities. We just looked at the investing activities section and got net cash provided by investing activities of $12,000. Now we're going to look at the financing activities section and see if we can't finish up this cash flow statement. All right, so back on our data template, we have identified that the change in notes payable is going to be reported as a financing activity section. I need to widen that again so we can see everything. We see that notes payable increased by $8,000, but we know from the investing activities section that part of that increase or part of that change was due to $18,000 that was borrowed to buy some plant and equipment. So not all of that is, due to the $8,000 is not all of the change in notes payable is what I'm trying to get my mouth to say. Then we've got capital stock that increased by $15,000. That's a financing activity. And we said that any dividends that were paid that affected retained earnings would also be a financing activity. So we go back down here to our additional information, and this is where we're going to see an explanation for some of the changes that we didn't quite fully explain in the balance sheet. And again, I'm logical sequential, so we'll start with number 1 in the additional information. It says that the company declared and paid a $4,000 cash dividend. Cash transaction with owners is a financing activity. So we'll come over here to our cash flow statement and list cash dividends paid. And that amount was $4,000 and it was paid, so it needs to be a negative. So we've got that in there. And then we've already accounted for number 2. And on the plant assets, the $2,000 that was cash paid was accounted for in investing activities. So we go down to number 4, and it says we repaid a $10,000 note payable. Cash transactions with creditors are financing activities. So we're going to put down here cash paid it just says cash paid on notes payable. So we're going to put that negative $10,000 in the financing activities section. And back on our data template, I had started kind of explaining in the T accounts what had happened we looked first at the plant assets and we started on notes payable. So let's see if this now explains fully the change in our notes payable account. We paid $10,000, so that would be a debit to notes payable and a credit to cash. Now let's check our math. Beginning balance was $245. And we borrowed $18 to buy that plant and equipment. Then we paid $10, so we subtract that out, and that does indeed equal our ending balance of $253,000. So we have explained everything that changed the notes payable account, either through non-cash investing and financing or a cash payment on notes payable. All right, so we can go back to our comparative balance sheet now and see what else. So we've accounted for the notes payable. Now the next item is the capital stock. Capital stock increased by $15,000. And they only list one account. They don't show us common stock, preferred stock, additional paid-in capital, so it can be more complex. But it's still, we're looking at a transaction with owners. So again, we go down to our additional information, and we've already seen this. Number 5 says owners invested $15,000 in the business and received additional shares of stock. Well, that's our $15,000 increase in the capital stock account, and that is a financing activity. So we issued shares of stock, they gave us money. So in the financing activity section, cash received from issuance of stock, or it can simply say from owners, invested by owners. That's $15,000. And since my template's out of lines, I must be finished with all of these, but let's just double check. We explained every one of these. We dealt with the dividend. And now I want to look at that retained earnings account. I want to make sure that I've explained the change in retained earnings from a beginning balance of $58,000 to an ending balance of $20,000. So I'm going to go back up here to my T account, and I'm going to take out all my notes payable stuff, and I'm going to put in retained earnings. Again, owner's equity account, so it has a credit balance. The beginning balance of retained earnings was $58,000, and the ending balance of retained earnings was $20,000. Beginning retained earnings plus net income, but remember, we had a loss, a net operating loss. So that net operating loss would reduce retained earnings. That when we close it out, it'll be a debit to retained earnings. And we paid dividends, and dividends also reduce retained earnings. Let's see, I believe the dividends we paid, we were told, was $4,000. So let's see, $58,000 beginning credit balance minus $38,000 in debits between the net loss and the dividends does indeed equal $20,000. So we've explained the change in retained earnings also between the net loss and the dividends. We didn't have any prior period adjustments or anything like that. That would be one of those items we'd have to adjust net income for. All right, so that's everything in our financing activities section. We've got $14,000 in negatives and $15,000 in positives. So we've got, once again, net cash provided by financing activities in the amount of $1,000. And again, these are in the outer column because they are sums of the amounts in the inner columns. Now, the next thing that we have to do is now we sum the sections. The cash provided by operating activities plus the $12,000 cash provided by investing activities plus the $1,000 cash provided by financing activities. We add those up since they're all positives. If we had cash used by, of course, we would offset that against the cash provided by. And we've got a net increase, in this case, in cash in the amount of $50,000. Now again, before I go any further, actually my next section is to do exactly what I'm about to do here, but I want to go back and check. My comparative income balance sheet showed beginning cash of 10, ending cash of 20, an increase of 50,000. So my numbers agree with the change in the account that I got when we first started this problem. Now, the next thing that we need to do, I have confirmed, I've explained my change. Now we need to show the investing and creditor public who read the financials that I have explained the change in beginning to ending cash. So to do that, my net increase, I then add my cash and cash equivalents at the beginning of the year. And it may ask you for a date, so that would be January 1, 2018. And I pull that from the comparative balance sheet, and there it is down there at the bottom. I'll scroll down a little bit more so that's more in our line of sight. That's $10,000. So I pull that in here. And then the $50,000 change in cash, increase in cash, plus the beginning cash and cash equivalents should equal my ending cash. Or December 31st. And we got $60,000 on the cash flow statement. Just to double check, sure enough, that is the amount of ending cash on the comparative balance sheet. Now, if they do not agree on homework, you can just suck it up and take the lost points. But in reality, me, the accountant, I have to find the difference and correct it. Find my mistake, find what I overlooked, and I have to correct it. Okay. Since we have already done the non-cash investing and financing activity explanation, we have completed our cash flow statement. So again, the sections, of course the heading, for a period of time, because we're explaining how cash changed from the beginning to the end of the period. Operating activities section, cash transactions related to generating profit is what this section shows us. Our day-to-day operating activities. Under the indirect method, we start with net income. We adjust for any non-cash items, whether they be expenses, as was the case for us, or non-cash revenues. We adjust for non-operating gains or losses, add back the loss, subtract out the gain. Then we adjust for changes in current assets and current liabilities. And we have an example of each of the directional changes. We had an increase in inventory and a decrease in accounts receivable. So add the decrease of current assets, subtract the increase in the current asset. We had an increase and a decrease in a, I think this one was actually accrued expenses payable. I labeled it the same thing. Y'all were probably wondering what in the world she did there. A decrease in a liability, a current liability, is subtracted, and increase in a current liability is added. And that gives us the net cash from operating activities. Then investing activities, that's the company investing in itself. So buying land, buying equipment, selling old equipment, replacing it with new equipment, the cash from that goes in this section. Also, if they invested excess cash in securities or sold some of those securities and got cash, that goes in this section. Then financing activities, cash transactions with owners, like dividends paid and issuance of stock, cash transactions with creditors, borrowing and receiving cash, repaying the principal that we borrowed. And then the sum of the three sections gets our net change in cash. Then we reconcile that to the ending cash on the balance sheet by adding beginning cash to the net increase or decrease in cash. And then finally, the non-cash investing and financing activities, where we use borrowed money to buy a piece of equipment or something to that effect. All right, so that ends our illustration of the cash flows statement.